So let's talk about Germany. Many countries in Europe today are facing a major dilemma. Their economies are being heavily impacted by the war in Ukraine and the global energy crisis. Thanks to sanctions on Russia, the EU has lost access to some of its previously affordable energy, and the pressure on their industries is increasing every day. Germany in particular is reaching a critical point. Industries that rely on low-cost energy are struggling to stay competitive. For years, Europe imported large volumes of Russian gas. But with these supplies falling and U.S. liquefied natural gas (LNG) filling the gap at much higher prices, manufacturing costs are soaring. To put this into perspective, in 2021, Russia supplied over 150 billion cubic meters of gas to Europe, while U.S. LNG accounted for only 21 billion. Russian volumes have since dropped, while U.S. LNG imports have increased significantly. Today, roughly 57% of Europe's LNG imports come from the U.S. This shift has made energy much more expensive for European industries. Germany's manufacturing sector, which includes cars, chips, and chemicals, is facing rising costs. Industrial production fell in December by nearly 2%, which is particularly concerning during the holiday season. Higher production costs are affecting consumer prices and the availability of goods like cars and EVs. Adding to the challenge, U.S. tariffs on certain imports make it even more expensive for German companies to operate abroad. While moving factories to the U.S. could avoid tariffs, it comes with high costs, competition, and uncertainty. Companies like Volkswagen have paused plans for new U.S. factories, partly due to the financial risks involved. Meanwhile, German investments in China are increasing. Foreign direct investment from Germany to China recently rose by 55%, signaling that companies are seeking lower-cost production hubs and access to global supply chains. China remains a major center for manufacturing, especially for higher-tech goods, and this trend is likely to continue. Another concern for Germany is its gold reserves. The country holds nearly $600 billion in gold, but a significant portion is stored in vaults abroad, including over 200 tons in the U.S. For German lawmakers and financial planners, this raises questions about accessibility during times of fiscal stress. Gold reserves are meant to act as a financial safety net, but logistical and geopolitical factors can complicate access. Germany is planning a $500 billion Euro infrastructure fund to modernize its economy over the coming years. That's around $60 billion per year from 2026 to 2029. With borrowing costs high and energy prices elevated, utilizing gold reserves or other financial tools could play a critical role in funding this plan. Central banks around the world are increasingly buying gold, and demand has been rising steadily. This trend reflects broader concerns about financial stability, inflation, and currency risks. For Germany, the timing and logistics of managing its gold reserves will be crucial if they need to support industrial growth or respond to economic challenges. In summary, Germany is at a crossroads. Rising energy costs, industrial pressures, global trade dynamics, and the management of financial reserves all intersect to create a challenging environment. Decisions about where to invest, how to secure energy, and how to utilize resources like gold will shape Germany's economic path in the years ahead. What do you think? Will Germany continue to expand investments in China? Will it bring more of its gold reserves home? Let me know your thoughts in the comments. Stay safe and be sure to like and subscribe as we explore these complex financial dynamics.